Hello, Eddie Denny here, here in Long Island, not in Jackson Hole, Wyoming. This is actually the Grand Tetons is the background that I'm showing you. My wife and I had a great week away over in the national parks. We saw Yellowstone National Park. First thing that happened when we entered the park is as we were driving slowly to take some pictures, suddenly three bison jumped into the into the picture as we were driving. It was like a real close-up view, so that was a good way to start things. And by the end of our stay for 2 days in Yellowstone Park, we sort of had our fill of bison. Got the basic ID. Saw a couple of bears, one mama bear with three cubs, so that was fun. I saw some elks. Turns out that the elks were in one of the villages, just grazing on the grass in the village itself, so we didn't have to go out into the wilds to find elk. But it was very, very enjoyable. Beautiful country for sure. And we did have a little bit of altitude sickness, which is the title of my morning briefing. Along the way, I did write the morning briefing for Monday, for today, and that's what I want to go over with you. The market has obviously has had some altitude sickness. Hopefully, the worst is over. I think it is. But let's have a look at some of the charts here that are relevant to this subject. So here it is, June 6th. We're together again live for those of you who are joining us Monday at 11 a.m. Eastern Standard Time. Others may be joining the recorded version of this. But let's start with the markets. The markets had a pretty good rebound here the past few days. It's back up over 4,000. Latest reading is 4,166, so it's doing well. Monday morning got a bit of a boost on the perception that the COVID disaster in China, or at least China's disastrous way of dealing with a pandemic, is being eased off, and the China's economy is starting to open up. In addition, Amazon had a stock split, so the stock's a lot cheaper, and it's had a nice little run here this morning. I guess as perhaps retail investors viewed it as a more attractive buy at a lower price. So everybody knows fundamentally it doesn't really change the story in the least bit. But we know that we still have an inflation problem. We know that there's been some signs that inflation has peaked, but nothing really definitive. We're going to have another inflation report later this week. As a matter of fact, on Friday. It's annoying when these things happen on Fridays, because then the market has to figure out, investors have to figure out whether they want to ride things through over the weekend. But we'll get a CPI number on Friday, and that'll be the reading for May. I think the expectations is that we'll continue to see some moderation in consumer durable goods inflation. But on the other hand, energy prices keep going up, food prices keep going up. So the headline inflation rate is going to be troublesome. As is the rent component of inflation. So we'll see how that all plays out. But I think on balance, that the data is likely to show that we're still in a peaking process here in the inflation picture. We certainly got some moderately hopeful news on Friday when the payroll employment numbers came out. We all looked at wages, and the wage numbers continue to show on a 3-month basis at an annual rate that they are falling below the year-over-year rate, which is an indication that the underlying inflationary pressures in the labor market may be easing off some. But all in all, the market has had a nice little bounce here. I guess we can spend some time debating whether it's a bear market bounce or whether it's the beginning of better times. I'm really more thinking that we're going to continue to see a volatile market moving more sideways than up or down from here, and that the downward move we've had so far this year has been totally related to the altitude sickness that investors have had vis-a-vis the valuation multiple. The PE multiple has been high, and it's come down a lot. Question is, does it have to come down a lot more? And the answer is no, it doesn't have to come down a lot more as long as there's no recession out there. We did raise our recession concerns, the probability of a recession a couple of weeks ago from 30% to 40%, but that's still not our best base case, and consumer still looks pretty good. By the way, for Tuesday morning, I'm writing a piece on tentatively titled Jamie's Hurricane. So I'm looking at the Jamie Dimon scenario that he discussed last week, Wednesday, in which he said a hurricane's coming. Just doesn't know whether it's going to be a minor one or something like Hurricane Sandy. But he sounded pretty alarmed, and he sounded like he was doing something about it in terms of the bank's balance sheet. Whether you agree with Jamie or not, the fact of the matter is he's awfully powerful, since he does run the country's largest bank. And if he's going to turn more conservative on his balance sheet, that means that lending standards will be tightened. So that increases the chances of a credit crunch, I suppose. But I don't think it goes to that extreme. And I think we are likely to see tighter credit conditions, and that's will be consistent with continued growth, the slow growth in the economy. Let's look at the valuation multiple. This is where all the negative action has been really since the beginning of the year, though the forward PE of the S&P 500 peaked a while ago back here in 2020. But it kind of held its own quite impressively there in the face of rising bond yields, in the face of rising inflation. But starting on January 3rd, the market decided that things had changed pretty dramatically on the inflation outlook side and on the Fed tightening side. The Fed certainly had been talking a lot more hawkishly. And by the way, here we are in early June, and the Fed has started its quantitative tightening, which means letting its balance sheet run off. And it's a substantial move here. I haven't seen any Fed officials really formally come out and said, this is our estimate for what this is equivalent to in terms of a hike in the Fed funds rate. I would say my guess is that just based on what the Fed is likely to do in terms of letting its balance sheet decline over the next 12 months, that's probably equivalent to something like maybe a full percentage point in the federal funds rate. Just a total guess, seat of the pants kind of a thought process here, which means that the Fed isn't going to have to raise the Fed funds rate all that much. It may be that the Fed's current stance, which is they're going to do 50 basis points at each at the next two meetings, so June, July, that may be enough combined with quantitative tightening to tighten credit conditions enough to slow the economy enough to bring inflation down enough. So that may do the trick. That would still leave the Fed funds rate below its so-called neutral rate at 2%. That would be below their estimated neutral rate. Last I saw was about 2.5%, let's call it. So they may want to take it there anyways, but the market, I think, is pretty well discounted it. The question is whether the market has discounted quantitative tightening, and the answer the past so far in June is that the market knew it's coming, it knows it started, and yet the market's actually been pretty firm. So that's good news. And so it does kind of corroborate my current view that the forward PE may very well have found its base here around 16 and a half. It's bounced up to 17.4. Kind of doubt it's going to go to 18, 19 back there again, given the tightening of credit conditions and what we know the Fed is doing and is likely to do. So let's look, there's a chart here on the forward PE using market cap weighted and median. Either way, the market's been expensive, particularly expensive, benefit of hindsight, obviously, with on a market cap weighted basis. We got to this level, and a lot of that had to do with the mega cap 8 stocks, clearly. We can look at other valuation metrics and see how they've come along. And while the forward PE has come down quite significantly, and it's now kind of at levels that make more sense in an economy that's growing at a slow pace with the tightening credit conditions, it makes more sense as long as there's no recession. If there is a recession, we're going to have analysts scrambling to cut their earnings and investors will pay even less for those declining earnings. And so as we've seen in previous recessions, the forward PE can go down quite a bit. Right now, what we're saying is that in prior recessions, the history shows that you typically go under 15. When you actually go into a recession, it can go into the single digits pretty easily. What still looks out of line here is the price to sales ratio. This is forward price to, it's the price of the S&P 500 divided by the forward revenues of the S&P 500. And that's the so-called Buffett ratio, if you will, except we do it daily. And you can see that that's not a bargain. So that is something to be concerned about. We really haven't seen any, we haven't seen the end necessarily of a correction in the price to sales ratio. But as you can see, the revenues expectations of the analysts, as I've been letting you know every week for quite some time here, we can see that the forward revenues expectations of the analysts continue to rise into record high territories. You can see that because the profit margin has moved up to record highs and apparently is staying there for now, we've seen that analysts' forward revenues or earnings expectations have also continued to climb. If you look here, put a magnifying glass, you might see a little bit of some of the concerns about the profit margins in some of the retailers, but all in all, the trend is still very much to the upside in terms of analyst consensus expectations for earnings over the next 52 weeks. That's forward earnings. That's the time-weighted average of their expectations for this year and next year. And the implications of these two numbers is the red line here. And again, the profit margin is remaining remarkably high, despite the fact that of labor shortages, higher wages, higher commodity costs, and all the reasons the profit margin should be getting squeezed. There's no sign of that in the forward profit margin calculated from the analyst consensus expectations. Well, let's go back to the valuation multiple and look at the S&P 500 PE ratio. And we have data going all the way back to 1935. From 1935 to 1978, it's trailing reported earnings. And then since then, it's what we think really drives the market, a forward-looking view of earnings, analyst consensus expectations. And so from 1979 to the present, we're looking at forward earnings. So it's a composite. It's kind of glued together, if you will. And there is clearly an inverse relationship, correlation between inflation and the PE. And we've seen this pop up in the inflation rate, bringing lots of bad memories for some of us who actually lived it of the 1970s environment. Of course, back in the 70s, it really started in the mid-60s with President Johnson's guns and butter approach to Vietnam. And we saw an upward trend in inflation. First, it was kind of gradual, and there were some dips along the way, but it was an upward trend for sure in the inflation rate. Here, we've just kind of out of the blue seen this thing pop up pretty dramatically. Benefit of hindsight, it wasn't totally out of the blue. It was clearly related to helicopter money, way too much money dropped by the Treasury and accommodated by the Fed that led to this big spike in inflation, plus all the pandemic factors that had an influence. So here you can see the forward PE has come down rather sharply. And again, the question is that enough? We had benefit of hindsight. We had motion. We had altitude sickness back then. We've come down a lot. And are we back to kind of a level that the market can hold? I think so, as long as we don't have a recession. So now let's look at this rule of 20, just another way to slice and dice valuation multiples. This is something I learned from a colleague of mine back at CJ Lawrence, Jim Moltz. He said that one way to think about where the PE should be, kind of a fair value PE, there's all kinds of different models. He kind of liked this idea of 20 minus the year-over-year percent change in the CPI inflation rate. So it gives you some indication of, relative to that rule of 20, where is the forward PE, and is the forward PE still too high? And based on this, the forward PE is too high because it's this says that the rule of 20 PE should be at 12%, roughly speaking. Fortunately, this is not scientific. This is not something that really has been all that helpful in positioning either on a long-term or short-term basis. But it is something to be unsettled about because it does focus on the relationship of the valuation multiples strictly to inflation. Just another way to basically look at the same chart we looked at over here. And again, there's an inverse correlation, but it's not a tight one for sure. There's another kind of spin-off of that, and that's the misery index, which is this time it's the inflation rate plus the unemployment rate. And again, there's a inverse relationship, not a tight one, but an inverse relationship with the misery index and the PE. And people are clearly more miserable as inflation has gone up. On the other hand, the unemployment rate is historically low. And so the misery index is elevated. And again, the question is whether the forward PE is discounted this amount of misery. And I think the answer is yes. The question is, related question is, there a lot more misery ahead with the unemployment rate soaring and inflation remaining high? And that's not my base case scenario right now. Now let's move on here a little bit faster. This is just again, the composite trailing and forward PE with a 15 line, so you can compare it to what happens during recessions. And during recessions, you typically see that you fall below 15 for forward PE, substantially below during recessions. And so that's something to be aware of, be concerned about. But again, I don't see a credit crunch, even though Jamie Dimon is getting more cautious with his balance sheet. And the consumer still looks to be in good spending shape. I do, as Jamie Dimon indicated, one of the concerns he has is that the Ukraine war will lead to the price of oil going up to $150 to $175 a barrel. That would be a concern for a recession scenario. But here we are at $120 a barrel, and there's certainly no shortages. There's no lines the way there were in the 1970s. And as a percentage of consumers' budgets, it's not as high as it was in the 1970s, though. Again, it's easy for me to say I can afford to pay some more for gasoline, but there's a lot of people who can't, and it's really starting to squeeze a lot of the lower income people who have to spend more on gasoline, groceries, and rents. So that segment of the economy may be where things start to really weaken. Question is, can they weaken enough to cause a recession? We did see some weakness here in car sales, which was kind of interesting because I think the car production has actually picked up here. So that's somewhat of a concern here. But we also know that we're not the only ones, my wife and I are not the only ones spending more on services, going on trips, getting on airplanes. The airplanes were full going out to Salt Lake City, as well as from Salt Lake City to Idaho Falls. The Jackson Hole Airport is actually closed for expansion. They got so many, they used to be a town for millionaires, now it's a town for billionaires. And I guess there's so many billionaires plus millionaires plus wannabes out there that they've had to expand their number of runways. But Jamie Dimon pointed out that the consumer still has he thinks there's about $2 trillion in excess savings. I think it's more like $1 trillion. If you look at the 2-year change in, this is the red line, look at the 2-year sum of personal saving, you can see that over the past 2 years, they accumulated $2.3 trillion in personal saving. In the past, prior to the pandemic, their rate of accumulation was more like $1 trillion. So that leads me to conclude that they stashed away an extra $1 trillion. That doesn't mean they're going to go out and spend it all. There could be some precautionary balances out there as a result of the pandemic, concerns about recessions and so on. But there still is a lot of liquidity. And as cautious as Jamie Dimon sounded, he acknowledged that consumers probably have enough of wherewithal to spend for the next half year, maybe full year. Meanwhile, we continue to watch the regional business surveys, regional capital spending. Looks like it's starting to get weaker here when you look at the current, that's the future expectations. The current one is still kind of holding up. So consumers are still okay, businesses are still okay. Hence, our view that a recession is not the most likely scenario right now. We are concerned, we have been concerned of late about the regional composite index, which is down to minus 0.5. And that has had a pretty good correlation with the national composite MPMI, but wouldn't you know it, just when you point that out, it doesn't work as well. You can see that the national MPMI has actually held up pretty well without any evidence that it's about to fall down to 50. But then again, if you look at the relationship closely, I guess we could do that with anything. You'll see that sometimes the regional composite gives you a little bit of a leading indication of where things are going. This is the new orders. Both the regional and the national new orders are looking weaker, but not recessionary, not under year. Employment's sort of a mixed bag. You got the national employment indicator looking fairly weak, but the regionals looking fairly strong. Of course, we know that housing is probably falling into recession. The new purchase index for mortgages is down, and that's where most of the weakness is likely to be in terms of looking at the sectors of real GDP. Consumer sentiment's depressed, mostly because inflation is high. This is the consumer sentiment index, very sensitive to inflation, much more so than the consumer confidence index. And that's worrisome. It's kind of recessionary levels, but the consumers are spending. Finally, I think this was finally, yes. Finally, we did cover the wage numbers in Friday's employment report. This is what I had in mind: is the yearly percent change is 5.2%. It looks actually it's kind of stabilizing here. And when you look at the 3-month percent change, you can see that for the past 1, 2, 3, 4 months, the 3-month annualized rate has been slightly below that at 4.4. So that's encouraging to the extent that it suggests that the near-term pressures are actually easing a bit rather than getting worse on the inflation front for wages. Goods producing, sort of a mixed bag. Service producing is where we're seeing some moderation in the 3-month relative to the 1 year. Well, that's it on my monologue here. Why don't we open it up for some discussion here? And let's see, we got Doug. So far, I've only got a question from Doug. So if any of you want to jump in with a few more questions, please do. Does the Dallas Fed's inflation numbers of 3.04% and 3.02% the past 2 months give you hope that inflation has peaked? And more importantly, do you think the Fed will think so? Doug, I have to admit to you, I was on vacation. I haven't paid enough attention maybe to those specific numbers. I try to keep on top of all these things all the time, but I'll have a closer look at those. I'm not a big fan of looking at the trim and the mean and all these other various measures. I just as soon focus on the CPI and the consumption deflator. And I have become a fan of looking at the 3-month annualized kind of numbers to see what they're suggesting are the near-term inflationary pressures relative to the year-over-year comparisons. Year-over-year comparisons tell you not just about what's going on today, but also about what happened a year ago. And I think when you combine that information with the 3-month at an annual rate, you get even more insights. But I'll have a look at that, Doug, and probably write about it. Oh, okay, getting some good questions here now. Scott, under investment in all commodities is significant, especially in oil and natural gas. Oil companies will not make investments that requires a return on investment over 6+ years or longer, with activists and politicians not doing the necessary cost benefit required to make good decisions. How much pain does the world need before people wake up to the huge underinvestment problem? Scott, that's a great point. It's a point I've been making on a regular basis. Climate activists, environmental activists have been very successful in putting a lot of political pressures on natural resource companies that to cut back on their capital spending for exploration and for production and distribution. I think the head of Chevron was recently basically said it outright. He said, what incentive does an oil company have to build a refinery capacity when it takes years to get a return on that kind of investment? And all the politicians are saying that they want to kill fossil fuel as an energy source within the next few years. So it does put a lot of upward pressure on commodity prices. And that may very well be where the biggest recession risk is that kind of delusional, what else can I say, delusional climate activist policies that are not driven by any sort of cost benefit analysis, just sort of like a mad dash to ban fossil fuels or make them so expensive that it forces everybody to go into renewable sources of energy, electric vehicles and the like. The only problem with that is it's a commendable motive and goal from a cost benefit analysis. It's delusional. It's just not practical. It just doesn't work. And it's going to create more pain than that. So I think, as you know, I've been talking about, is this going to be like the 1970s or is this going to be like the roaring 2020s? And I guess, being an optimist at heart, I've been arguing that while it feels like the 1970s right now, it will morph into the roaring 2020s. The 1970s analogy has a lot going for it, and then some from this point of view that we're underinvesting in commodities. And in the past, higher commodity prices were the cure for higher commodity prices because they led to more production. But this time around, that doesn't seem to be the case, and it is becoming a more worrisome development. We'll be watching it. Scott, it appears more experts are predicting lower earnings estimates coming from analysts. As you mentioned, with a recession that seems possible, but is it possible without a recession? Good question. Yeah, I've been basically addressing this issue every single week as we've been getting weekly data on analyst consensus expectations for S&P 500 earnings for this year and next year. And then we take the time-weighted average of those two and monitor the forward earnings. And as I've been pointing out, and I just pointed out again today, forward earnings, forward revenues, all-time record high, forward earnings, all-time record high, profit margin hanging in there at an all-time record high. So the analysts, maybe they're delusional. Maybe they didn't get the recession memo. If a recession is coming, it's going to be the most widely anticipated recession of all times. And yet the analysts don't seem to be getting the picture or the memo. And that's because analysts don't predict recessions. They take the information they get from their companies on a current basis. It's not their job to forecast recessions. It's your job and my job as investors to decide whether they are being unrealistically optimistic about earnings because they simply aren't factoring in a significant risk of a recession. Obviously, this altitude sickness we've experienced in the stock market since the beginning of the year has been all about investors looking at analyst consensus expectations and not believing them and thinking they're way too optimistic as they continue to raise them into record high territory. And the investors have said, okay, they can think whatever they like, but we're not going to pay 20 times forward PEs anymore for that. We're not going to pay 19, 18. Well, maybe we'll pay 16, 16 and a half. And today they seem to be paying 17 and a half for those earnings expectations. So the investors, at least the past few days, have had kind of second thoughts about the inevitability of a recession, but that could change, as we know. Vincenzo, should we have now a higher premium on U.S. stocks, given that China perhaps is not really investable, emerging markets, Russia, Europe? Vincenzo, that's a very good point here, is in many ways, so far this year, the world's become a narrower field for investors. You're absolutely right. China looks less and less investable. We wrote about it again on Thursday. That's been our position for quite some time, that China is not a good environment for free market capitalistic investors. Government meddles in business too much, and it's an authoritarian, totalitarian regime. So why would you want to even think about providing them with any capital? And then Russia is certainly not investable anymore. I think the BRICS are now the BICS. They've taken out Russia from that. Europe, if anybody really has underinvested, in commodities and in food and energy, it's certainly been the Europeans. And so they're particularly vulnerable to a recession. And again, from that perspective, the US looks pretty good. Vincenzo, it sounds like you and I had the same upbringing. We both probably had happy childhoods. So we're looking for, we tend to side with things that give us some hope about the future. And what you just pointed out makes a lot of sense to me. But then again, we can't dismiss the fact that the Fed still has some tightening to do. We don't really know what QT implies in terms of the impact on credit tightening. We don't know whether the price of oil and other commodity prices have a lot higher to go, and that ultimately I'm sure that the cure for high commodity prices is high commodity prices. But in the past, it used to be that the high commodity prices led to more investment and more capacity. Now, the reason that high commodity prices will lead to lower commodity prices is they could cause a recession, particularly if food and oil prices continue to move higher. Michael, Charlie Munger, you never want your banker to be an optimist. Okay, thanks, Michael. I appreciate that insight. But then again, I'm your research advisor. I'm not your banker. Anonymous, if quantitative tightening is equivalent to 1% in the Fed funds, will the Fed stop QT early as in 2019? Yeah, I mean, I know when you say early, I haven't heard that any Fed official has specifically pinned down any end date for when QT2 terminates, nor any particular amount of reduction in the Fed's balance sheet. I think there's just an assumption that QT2 will continue through 2023 and probably through 2024. But that's, I think, maybe a consensus assumption more than anything that's really significant insight or anything that the Fed officials have pronounced. And I mean, that 1% is just a off the cuff opinion. I have no quantitative method or econometric model for telling you exactly what QT. Again, I don't really know how long QT is going to last for. And what we saw back in QT1 is it didn't last for very long. William, I'll take a couple more questions. So let's see, fiscal largesse has been characterized as $6 trillion of fiscal stimulus to cover a $2 trillion hole from the 2020 recession. Does that sound right? Yeah, it sounds right. It sounds like, what we've had since the start of the pandemic is what can only be described as a unique experience of helicopter money, where the 6 trillion is, the combination of the fiscal deficit and the amount of accommodation that the Fed has provided. So I think the proof is in the result. The result is we've had this astonishing increase in inflation, really just over the past year, and that can only be attributed to helicopter money, which is just excessively stimulative fiscal and monetary policy. I'll take one last question here. Anonymous, Piper Sandler believes we're nowhere near a market bottom based on the ISM data and think it won't be until late 2023. Thoughts? It's a good question. I've been looking at the ISM data. If you look at, and I've shown some charts, and the charts show that if you take the ISM manufacturing index, the MPMI, and on the same chart, put in the year-over-year percent change in the S&P 500, they track each other, or the S&P 500 tracks it very, very well. And the same thing goes if you take the S&P 500 year-over-year percent change and put it on the same chart as that regional survey of the five conducted by the five Federal Reserve banks. Both of those kind of charts show that the market's pretty much where it should be relative to where the PMIs are right now. In other words, it should be around 4,000 to 4,200. So I don't see where this. I don't see in the charts I'm looking at any evidence that the market right now should be a lot lower based on what we know is going on with the purchasing managers. And that's the MPMI. It's not the non-manufacturing PMI. So I think right now those indicators, they're not in recession territory. They're not under 50 or less, and they do indicate that the market's just about where it should be. So that's just about where I am right now. So with all that, hope you enjoyed the background here. We had a great time at the national parks, Yellowstone and the Grand Tetons. Hope you had a good week. Hope you have a great week up ahead here. And let's do this again next week. Thanks again.